Joining us today, Credit Suisse Chief U.S. Equity Strategist, Head of Quantitative Research, Jonathan Golub. Jonathan, great to see you. What are you seeing in earnings and why the move at this point?
So we're lowering our earnings for 2023 by $5, which is not a lot. And it's primarily, there's really two drivers. First of all, margins are coming in broadly worse. The one change is that the energy sector, which had fantastic margins last year, those are now expected to roll over along with other areas like tech. So, but that's a small adjustment. The really big adjustment is the market is expecting a huge V-shaped bounce in earnings in 2024. And we just think that that's just not going to materialize, that we're more likely to be in an anemic economy. Consensus view is that GDP over the next 2 years runs 1%. So we avoid a recession, kind of the no landing scenario. But if there's no landing, there's no V in earnings. If there's no V in earnings, the 2024 numbers are way too high, and we took those down as well.
Right. Is any of this contingent on February and March data, especially in the labor market, sort of ratifying what January told us, or is that irrelevant to your view?
No, it's not irrelevant. And if you look at GDP now, which is kind of interesting, which is the Atlanta Fed's view on how first quarter GDP is going to come in, it's going to come in 2.5% to 3%. So the markets, I think, getting their head around the fact that in the very near term, the data looks really hot. The employment data is really hot. The inflation data is really hot. But at the same time, if you don't have available labor, it's really hard for companies to grow their revenues in a meaningful way. And if the Fed is forced to tighten more, they're also going to be a headwind to the economy. So what we're probably looking at, putting aside the next few months, if you look at over the next couple of years, you're looking at inflation, which is going to stick around 3.5% or 4% on average for 2 years. GDP, which is going to look like 1%. It's what I would call stagflation light. It's not the kind of stagflation you had in the 1970s where the unemployment rate was really high and inflation was really high. It's just annoying inflation and subpar economic growth. And it's just lousy for corporate profits. Margins get beaten up. And employees do okay. The wages go up more than inflation. Employees will feel okay, but corporate profits will be weak.
Hey, Jonathan, we were just talking to Mike about valuations in the markets, and I'm wondering, if you think that the downside to your earnings estimates is that there is downside risk, I should say, to your earnings estimates still even after lowering them, because just doing the back of the envelope math, you're still expecting a PE of about 18 for 2023, which is just above where we are right now.
Yeah, but when you're talking about an 18 multiple, you're using the consensus numbers, which are really high. But if there's a risk here, the risk is to the multiple. The risk is that the earnings, if you said, where am I likely to be right or wrong? If I make a mistake, it's that the earnings are right, that these earnings don't bounce in 2024 like everyone expects, but that the multiple just finds this environment less appealing. And listen, Melissa, one of the questions that we're talking to people about is, with cash right now at 5%, a lot of equity investors are saying, if I can get 5% more or less guaranteed on short-term fixed income, why do I need to play in equities with all of these risks? And if that is, if more people think that way, then it's possible the margin comes down. But the earnings numbers, I think, are really the right. And I think ultimately the multiple's right too. And here's why I think the multiple stays where it is. First thing is we're going to avoid a recession. And that is hugely positive for multiples. That's a positive. On the other side, offsetting that is that inflation's going to be stickier. The Fed's going to go further, and you have a weak economy. So I really am comfortable with this flat PE outlook. But if I were to make a mistake, it would definitely be on the multiple.